Good evening. My name is Imran. I'm a UK and international tax specialist. So the purpose of this video to explain how the pension schemes work. It's very useful for ACCA, ACA, and CTA student. Also useful for individual to understand how contribution to pension scheme could have income tax saving. So the basic is if a company pay on behalf of employee any pension contribution, the company can have a corporation tax relief. It will be free for individual, so that is a free benefit. So it means individual is not going to pay any income tax. Similarly, if an individual with the higher earnings, so they can pay money in that pension pot. I would explain to you how does it work, uh, what's the technique, and what are the annual allowances for the pension, what is the annual charge for the pension, how you can utilize unused allowance from the previous years. So stay with me. Pension funds. An individual will have tax relief in respect of contribution to a registered pension scheme. Contribution to pension funds eligible for tax relief are restricted depend on the level of individual income. Taxpayer with a higher earning can make a larger pension contribution compared to taxpayer with a lower earnings. So one of the main advantages of the registered pension fund is that any growth is tax-free. The pension fund will not pay any income tax on any interest or dividend income, and it will not pay any capital gain tax. Pension funds. So the one we're going to discuss is the defined benefit scheme. So in a defined benefit scheme, the benefits an employee can take from the scheme based on the employee's salary and the length of the services rather than on the size of the fund. An individual reached to 55 can take 25% tax-free lump sum. The rest can be split between annuity to guarantee a certain income and flexible drawdown. So for instance, if you reach to 55, you can withdraw 25% lump sum tax-free. The rest you can use as an annuity to provide you a guarantee income. So that income along with the government pension, so that would be sufficient for individual to have a beautiful life. A taxpayer can obtain tax relief in any of the tax year, which would be 100% of his relevant earning. So anybody can pay up to 3,600 per year, even without having any earning. So contribution are not permitted by taxpayer or the age of 75. So obviously it's common sense. So it's the time to enjoy the pension, not to put any more money in that pension pot. Contribution can be made by a scheme member, a third party on behalf, like for example, such as parents on behalf of the child, or by employer or former employer. Relevant earning. What are the relevant earnings? So if you are working, you're employed, so your relevant earning will be salary, benefits, taxable termination payments, and the gain on the shares if you have any share schemes. For a sole trader individual, their earning will be from sole trader business, like trading income, profit from punished holiday letting are also relevant income. How the relief is given in two ways: relief at source and under the net pay arrangement. The first one at source is if you decided to have a pension pot and then or pension contribution. If you decided to have pension contribution of 12,000, so you will put in that pot 10,000. HMRC will top it up by 2,000. They will gross it up by 20%. So that is called relief at source. So it means that you will get that 20% at that stage from HMRC. Then when you're doing your tax return, so what will happen is that your basic band will be extended by the pension contribution, the gross pension contribution, and equally the higher rate limit will be extended by the same amount. Here is a Simon received a salary of 70,000. He made a contribution of 5,000 net. Okay, so at that stage, when you're calculating tax, ignore any pension contribution. Start with the basic salary minus the person allowance that give you a taxable income. Now here is, once you calculate your taxable income, now the pension will start to play his part. How does it work? You know, your basic band is extended by the gross pension. So net pension is 5,000. If you gross it up by 100 divided by 80, that will give you 6,000. So the basic rate band is extended by to 43,000. So the first, instead of 37,700, so the first 43,950 will now be taxed at the rate of 20%. And the gap between 57,430 is taxable income, minus the 43,950, which already been taxed by 20%. So the gap will be like subject to 40% tax. Remember, we already deducted personal allowance, so make sure you don't count it twice. Net pay arrangement. Under this pay arrangement, all you need to tell is to tell your employer that from your salary, you instruct your employer, or the employer will have some pension scheme. So you can tell them that from your salary, you wish to pay some money to the pension pot. Very useful. For example, what's happened if you having a wages of 125,000, so definitely you will not have any personal allowance. Remember, if your income in excess of 100,000, so for each £2 exceeding 100,000, your personal allowance goes down by £1. So the personal allowance is 12,570. So once you reach to 125,000, something like this, you don't get personal allowance. So if your salary is 125,000, you can ask your employer to pay that 25,000 in the pension pot for you. So what will happen? Your net wages will be 100,000. In this cases, you still like this 100K limit, so you will get your personal allowance back. So that the benefit is that 25,000 went to the pension pot without being taxed by HMRC. On top of that, you got your personal allowance back as well. So there's an additional benefit. So the pension contribution do not receive relief from national insurance. Remember, still the national insurance will be based on 125,000. However, the income tax will be based on 100,000, because out of this 125,000, you put 25,000 in the pension pot. So it's very simple. Annual allowance. Here the complication begin. So the annual allowance is, for 2022-23, the allowance was 40,000. Now it's been changed to 60,000 for 23-24. An individual annual allowance for a tax year is increased by any unused allowance for the previous 3 years. For example, in the previous 3 years, you were, so the condition is you were registered for the pension scheme, you were in that pension scheme, then you can take advantage of this. Otherwise, you cannot claim it from any unused pension allowance from the previous year. So the condition is that you must be, the individual was a member of registered pension scheme in that year. So here's an example. Victoria, a self-employed individual with earning of 150,000. Okay, she was a member of a pension scheme since quite a long time. So for 2019-20, she contributed 20,000. Then for 2021, she contributed 30,000. For 22, 50,000. For 23, 50,000 again. So what would be the allowance for 2023 and 24? Okay, let's see. There's a table, I put it for you. So contribution, she put 20, 30, 50, 50. Now, during that year, allowance were 40 for 1920, 40 for the following year, and then 40 for 2021-22, and then for 2022-23, still 40. Okay. So remember, she was a pension scheme member since 2018. So in 2019-20, she has unused allowance of 20,000. But in 2021-22, she is in excess because the allowance is 40,000 and she contributed 50, so 10,000 excess. And the same thing happened for 2022-23. So what we can do is that excess will be covered by the deficit from the previous from 2019-20. However, for 2020-21, we still have the excess 10,000, which can be carried forward for the following 3 years. So it means it can be added to 2023 and 24. So here's the explanation. In 2019-20, Victoria has unused pension allowance of 20,000 to be carried forward to the following 3 years, which was partly used in 2021-22 and 22-23. So in 2020-21, she has still unused pension allowance, which can be carried forward to be used for 2023 and 24. So 2023-24, the pension allowance is 60,000. We can add that 10,000 unused allowance from 2020-21. So this would make it to 70,000. So it means if Victoria put in the pension pot gross 70,000, so she needs to put a net amount. If you gross it up, it does not exceed 70,000. There will be no income tax charge, and she will fully benefit from that contribution in the pension pot. Tapered personal allowance, very important. Sorry, the words are very small. So if individual adjusted income is over 260,000, then their annual allowance is tapered. Tapered means is for any money for earning about 260,000, the pension allowance for each pound will reduce by 50 pence. So this means for every £2 it will reduce by £1. It will not be reduced if their threshold income for the current year is 200,000 or less. So remember, for every £2, if their adjusted income goes over 260,000, their annual allowance for the current year reduced by £1. The minimum reduced annual allowance will still be available 10,000. I mean, it cannot be reduced less than 10,000. So maximum reduction up to 10,000. For the tax years, up to, remember, the threshold income and adjusted income were different. Okay, the threshold income that is the definition: net income after pension minus the personal pension contribution, that gives you a threshold income. Adjusted income is the net income plus occupational pension plus contribution by the employer. That would give you adjusted income. You're always calculating first threshold income. If it's more than 200,000, then you jump to the threshold income. Especially in exam, you will be highly tested. Simon received a gross salary of 200,000 with a company car of 10,000, benefit value 10,000. He makes a personal pension contribution of 20,000 net. So you need to make sure you gross it up. And his employer contributed 20,000. Simon also received a property income of 20,000. So let's calculate first threshold income. So let's work out threshold income. So employment income, both the salary plus the benefits, so 210,000. Property income that reached to 230,000. Less gross pension contribution. Remember, make sure you gross it. So the threshold income is 205,000, which is more than 200,000. Therefore, we need to work out adjusted net income. Now, if the adjusted net income goes over 260, we need to reduce the pension allowance. If it is less than 260, don't bother. It means no tapering provision apply. We don't need to reduce the pension allowance. How to calculate the adjusted net income? Employment income, remember, as usual, the salary plus the benefit. Property income added up plus any contribution by employer. Adjusted net income is 250,000, which is less than 260,000. Okay, so therefore the tapering provision do not apply. However, if that amount would go over 260, so simple is that the pension allowance would be reduced. For example, if that would be 280,000, so the pension allowance would be reduced by 10,000 because it's 20,000 more than 260. So it will be divided by 2. So the result will be 10,000. So we need to reduce the pension allowance by 10,000. Very simple. Annual allowance charge, very important. Where the total pension input and the tax year exceed the available annual allowance, the excess is charged to income tax. This is called annual allowance charge. And the rate of the tax charge depends on the individual taxable income. The excess pension input is charged at the rate or combination of the rates which would apply if the excess were the top slice of taxable income for the tax year. So the aim of the annual allowance charge is to remove the tax relief on the pension saving in excess of the annual allowance. It means HMRC said this is the annual allowance 60,000. You can use any unused annual allowances, pension allowances, but keep it to that limit. We will not accrue any annual allowance charge. However, if you increase the limit, we would charge you. It means we will take the benefit back from you. Simon's salary is 182,000. Simon contributed net of 65,600. So that would give you a gross pension of 82,000. His employer also contributed 30,000. So obviously you can see based on the contribution is quite huge. So Simon has no unused pension allowance. If he would have any unused pension allowance for the past 3 years, yeah, so this could help him. So Simon taxable income, remember, Simon, because of his pension contribution, his net income, the net income would be 100,000. Based on that, he will get his personal allowance back. However, the pension contribution you don't deduct. It's extending the basic band. It also help you to work out your adjusted income. To see if you will still get the personal allowance. In our case, he will be eligible for a personal allowance, or he will get his personal allowance back because of his pension contribution. So, and again, we see that Simon threshold income is 169,430, okay, which is less than 200,000. Hence, Simon will have full allowance, okay. However, that is not. Now what we see is because he exceed the pension allowance. So Simon contribution gross is 82,000. Employer also contributed 30,000. So the total contribution is 112,000 less the annual allowance because he doesn't have any brought forward allowances as well. So his excess contribution is 52,000. Now HMRC would penalize him. How he would penalize him is this excess will be added to his taxable income. Simple. Simon basic band will be extended by the gross employee pension. Simon, remember, Simon gross employee contribution was 82,000. So the basic band will be extended by the same amount. So that would reach the base, so multiplied by 20%. Then what's happened is the higher rate band, so his taxable income is 169,430. So the higher rate limit also extended, but we don't need to extend it too much because it should be extended by the same 82,000 as well. Okay. Then obviously the annual allowance charge. Remember the excess pension he contributed, that would be added to his taxable profit, and that would be taxed at the rate of 40% because remember his higher rate also extended by 82,000 as well. So higher rate is up to 150,000. If you add this 82,000, so you still have up to 132,000 something. Lifetime allowance. Okay, current lifetime allowance is 1,073,100 for 2023-24. It means that the purpose is that each year you putting in your pension pot, make sure you don't exceed the limit. Okay, this is called lifetime limit. In exams, sometimes you can get 1 or 2 marks, but in real life, it's very important. With the pension value exceed this, a tax charge will arise. So the capital value of the fund at the benefit event minus lifetime allowance limit times by the percentage rate of tax. So the rate of tax depends on how individual chooses to receive the excess. So there are 2 rates. Remember, 55% if individual choose to take the excess as a lump sum, 25% if individual choose to leave the excess in the fund. So that's quite a big charge. So be careful you don't exceed the lifetime allowance limit. It means the maximum pension you can have up to like in your pot is up to 1,073,000. It was more in the past. However, HMRC reduced it. So thanks for watching. If you do have some question, you can leave me a comment or two, or if you have any question regarding pension and you wish that I can and solve that question for you, yes, I'm happy to do this. So I do have other videos regarding taxable income, exempt income, taxable benefit, taxation of dividend. These topics are quite hard. However, you need to read constantly, visit your book, do exercises, then visit relevant notes. My aim is just to make it very simple, but at the end of the day, it's still very hard. Okay, but still, I'm trying my best to make it simple for you. If you like what you see, you can subscribe to my channel. I'll be making more video about corporation tax as well, inheritance tax as well, VAT, and also capital gain tax. But because of the time limit, I work full time as a group tax manager. It's very hard for me to focus a lot, and I need to spend a significant amount of time to make this video and then to present it. However, just stay with me. I will be making more videos on the basic accounting as well, how to do a bookkeeping, how to get a job being an ACCA qualified. Thanks for watching. Having a good night.